In a disheartening turn of events, military conflicts have expanded across the Middle East. Naturally, spiking oil prices have been the most tangible market impact so far. Iran itself is a key player in the global oil supply, and critical energy infrastructure in neighboring countries could be at risk as well. These are the most immediate production concerns, but there are potential transportation issues too. More than 20% of the world's daily oil and gas products travel through the region's Strait of Hormuz. Any traffic slowdown or blockades could have a worldwide knock-on effect. A simple example is how restricted oil supply and transport could push up inflation, which is stubborn enough already. From there, economic growth could stall, or interest rate decisions could become more nuanced. But these are very much what-if scenarios and largely depend on the length and reach of the conflict. Until then, markets are trading headline to headline. We'd imagine that the US government doesn't have much appetite for a long drawn-out engagement. Midterm elections around the corner, and voters are concerned about domestic issues, namely the price of living. Higher oil prices are unlikely to help garner political support. While bond yields have risen somewhat in recent days, due to these inflationary concerns, equity markets have been surprisingly stable. Many investors seem to realize that such events often have a temporary impact on stock markets and therefore have chosen to remain invested. Bond investors are wading cross-currents. Yields have generally trended lower this year as expectations for further interest rate cuts rise. Kevin Warsh, the Fed chair nominee, appears more supportive of stimulus efforts. On top of that, concerns over AI automation replacing white-collar workers are rising. If structurally high unemployment comes about, more rate cuts are likely on the table. On the other hand, those same bond investors seem worried over rising inflationary pressures in recent economic releases, and that's before oil prices jumped. The US Supreme Court's decision to strike down the bulk of tariffs adds even more uncertainty. Companies are looking for refunds and filing lawsuits, while several countries have suspended trade agreements until the smoke clears. Regardless, if tariff revenues are not replaced, the government's rising budget deficit could punctuate existing debt concerns. That puts longer-term yields at risk of climbing. February was an interesting month for equity investors, with many international markets delivering strong gains, Canada included. The S&P 500 was less fortunate, suffering modest losses on the month. The recent sell-off in technology stocks is largely to blame. That's the nature of market concentration. It localizes risk to sectors or companies with disproportionately large influence over the index. The Magnificent Seven, for example, fell by more than 7% in February. Microsoft in particular has struggled, shedding over 30%. This could be attributed to a wide range of causes. The one most reported is the worry about massive capital expenditures from mega-cap companies, as well as the risk of automation and labor replacement in software businesses. New AI models could displace certain legacy products or skill sets, but we feel that the market's reaction is premature. Calling it the SaaSpocalypse, while catchy, could also be an overreaction. Innovation can make some jobs obsolete, but it also tends to create new ones. Capital continues to flow to other industry sectors and geographic regions, widening market breadth. This is the opposite of concentration and signals a much healthier environment where more businesses can participate in advancing markets. It spreads risk and opportunity more equally across a wider spectrum. Dividend growth stocks appear to be returning to favor in today's uncertain environment. In fact, the aristocrats are outperforming the likes of the S&P 500 for the first time in years. Our core income-oriented strategies are well positioned for this trend to continue. At the portfolio level, however, we're not overly reliant on it, with holdings in alternatives, growth assets, and international securities. We're prepared for a wide range of paths forward, which makes sense as our usual MO, and even more so in times like these. Once again, we find ourselves in an uncertain environment, something that few investors enjoy. This most recent episode, however, was a compelling snapshot of how well diversification can protect capital and enhance portfolio stability. Look no further than oil as an example. While some companies and industries will find higher energy costs to be a headwind, others are already benefiting from the growing need for power generation in our digital economy.